Investors naturally shy away from bank stocks during a recession. Memories of the 2008 financial crisis, caused in great part by the banks and resulting in a government bailout, are fresh enough. But this time around, capital levels are good and sturdy for the large U.S. banks, according to analysts. Here are 3 things you need to know about the banking sector as the U.S. struggles to recover from the coronavirus pandemic. The pandemic caused a big hit to bank earnings, as banks set aside more money to cover expected loan losses. That's called a provision for loan losses, and it is the amount of money put in reserves for commercial loans that a bank expects will not be repaid. As loan loss provisions go up, profits go down, and that's bad news for investors. But there's some good news for investors as well. The big banks are continuing to see a boost to fee income from elevated investment banking and trading activity, even as the coronavirus crisis continues. That's because the Federal Reserve's quick action to lower the federal funds rate, along with its aggressive bond purchases, have led to such a decline in interest rates that companies are rushing to lock in those low interest rates by issuing bonds. People are refinancing their homes for the same reason. All of this action, along with the remarkable recovery for the U.S. stock market from its late March lows, boosts banks' fee revenue. Still, a lot remains unknown as the U.S. continues to see a rise in COVID-19 cases. The credit situation for the banking industry is still opaque due to widespread deferrals and loan forbearance. So, even though large banks have stronger capital levels and much higher loan underwriting standards when compared to the years before the 2008 credit crisis, many analysts caution that the true quality of their loans is still a big unknown.